broadcast is now starting. All attendees are in listen-only mode.
Okay, good morning, everyone. Good morning. My name is Steve Ferrace. I'm Director of Marketing and Member Relations for Suburban West Realtors Association. On behalf of the organization, I'd like to welcome you to today's Starbucks Mornings program, 2018 tax changes, as well as tax issues that impact realtors. So we're excited to have you here today. Before we get into today's program, a couple of quick announcements from the association. We also have a sponsor here today, so I'll welcome her up in a second. We do have a number of other Starbucks Mornings on our schedule coming up. Our next one, actually, we're taking on the road. We're going to be at the Haverford Reserve Recreation Center on February 26th. We're excited to welcome John Russell, who is Senior Director of Government Relations and Business Development for the American Society of Appraisers, and he's going to be discussing valuations and potential risks to agents. So again, that's going to be February 26th, 10 a.m. to 11:30 at the Haverford Reserve Recreation Center. Hopefully we'll see you there for that. And then I'm just going to mention briefly, we have two upcoming from there. March 13th, back here at Suburban West, we're going to be talking about real estate photography. Again, 10 a.m. to 11:30 here. And then in April, we'll be welcoming Janata Rochelle, who is Director of Enforcement for the Pennsylvania Human Relations Commission. We had her here last year, and she's going to be discussing what's new in fair housing. That's going to be on April 9th here at Suburban West. So just keep an eye out for for more information on all those topics, and we'll hope to see you at one of our other upcoming Starbucks Mornings. In addition to that, again, you were all in receipt today of our tech helpline. I know many of you have already gotten that in the past. Again, it really is a terrific free member service available to you. Can certainly help with any issues that you run into, whether at the office or at home with your computer, with any of your electronic devices that are related to your computer. So again, for instance, if you have a slow computer, if you have a virus on your computer, if you have problems installing software or getting hardware connected to your computer, again, it really can really help you. And also a lot of smartphone assistance as well. They're run by They're run by a realtor association in Florida, so they are very familiar with your realtor technology needs. So definitely check it out if you haven't. They're available 6 days a week, Monday through Saturday, and it really has been a lifesaver for a lot of our members. So definitely take advantage of that. Okay, so we're going to welcome our sponsor. Our affiliate members are mortgage companies, they're home inspectors, they're stagers, they're of course involved in real estate, but they join here to provide a vital support to the organization. And it's not just financial; they really do provide a lot of educational opportunities. We have affiliate members who've taught Starbucks Mornings in the past. They've taught some of our CE classes here as well. So they really do give back a whole lot. And we're able to do so many of our seminars both here as well as offsite because of their support as well as their sponsorship. So we're excited to welcome up Lindsay Musser, who is sponsoring today's program. She's with Legacy Branding Gifts, and I'll turn the floor over to Lindsay.
Awesome. Thank you for that introduction. I appreciate that.
Hi, everyone. How are you? Good morning. I'm sorry it didn't snow. I tried my best. So for those of you who don't know me, my name is Lindsay Musser-Pacheco, Legacy Branding Gifts. I am in the business of client retention and client appreciation. They call me a client appreciation specialist. So I am a little bit different than other sponsors you may have seen or other vendors you may have met. I don't do mortgages, titles. I help you connect with your clients and create greater client retention. How many of you have noticed that it's easier and less expensive and more enjoyable to work with people you have already worked with in the past? Anybody ever notice that? Forbes said recently that 65% of people leave their salesperson. So that's real estate, insurance, anything in sort of that realm where they need to work through a person. 65% of people leave their salesperson because they sense that they are indifferent to the relationship. I don't know about you guys, but I've been in sales a long time. I'm not indifferent to any of my clients, but the numbers say that is not always getting communicated to our clients. And so I'm working with a company that does a lot of gifting and branding at the same time. And what we do is help you create a long-term awareness with your client and turn something like, for instance, your closing gift into a long-term awareness tool. One product that we use that's really, really famous. How many of you have Cutco knives at home? Does anybody own a Cutco set? Okay. I see quite a few fans in here. That's normal for a room this size. Does anybody have a set that's like older than 10 years? Older than 15? 20? Anybody have a 25-year-old set? How old is yours in the back there?
Mine has to be about 30 years old.
Awesome. Thank you. Okay. So I do that quickly to demonstrate that it's an heirloom product. People pass these down from kids to grandkids. And about 15 years ago, we noticed that a lot of agents and loan officers were coming to us and asking, can you engrave my logo, name, and number on a piece of Cutco? I would love to give that to my client instead of, for instance, a gift card, a gift basket. What are gifts that are often given in the industry and in all of business? And I'm not here to knock on any of those gifts, or if you've done something in the past, like take your clients out to eat. It's not that people don't appreciate it. It's just that 82% of people say they would use their real estate agent again. But 2 years after the first transaction, only about 12% of folks can actually name their realtor when asked. And I experienced this at the Philadelphia Home Show the other day. How many of you have ever gone to the Philadelphia Home Show? That's a great place to walk around and meet potential clients, by the way. And 2 people came up to the booth and they were looking at a Cutco set and they mentioned that they had just moved. I asked them, who's your realtor? Because I thought maybe I know them. I work with about 2,500 realtors in the area. And they stood there for approximately 6 minutes. It got super awkward. And they went back and forth and they said, she's like this tall, she's petite, dark hair. I finally said, what company did she work with? And they were able to come up with that. But it was just a great illustration. I wish I had it on video. It would have been weird to videotape that. But I wish I had that on video just to illustrate. I'm sure that agent thought that they would remember how hard she worked for them. I'm sure that agent thought that they were getting her emails, her other communications. The fact is that people just have so many people to choose from, and everyone has short memories. It's our job to make sure that a client never forgets us. So to wrap up real quick with what we can do, what does a knife have to do with real estate and connecting with your clients? Well, instead of giving something consumable that gets stuck on a shelf or hidden away somewhere, it's something that they can use every single day. I'll highlight this spreader piece here. This is one of our signature pieces. This is for peanut butter, mayonnaise, cream cheese. You can get all the way to the bottom of one of those giant jars from Costco without getting it all over your knuckles. You can cut and serve lasagna, pizza, cakes, pies. It's a really cool thing. Shows your logo great. Really big space there. And a lot of times, by the way, this is a spreader. People will give it as a referral gift and they'll say, thanks for spreading my name around. Haha. Okay, give you a couple of cool ideas like that for you. Just to hit quick 3 points that we can do for you. In addition to taking your closing gift from something consumable or forgettable and turning it into something they will use every single day for the rest of their lives. By the way, if they have this for 20 years, that's 7,300 touches just from the closing gift. And there's no other closing gift out there that can do that for you. Secondly, since we're learning about taxes today, who knows how much you could normally write off for a closing gift? Just shout it out. $25, okay? That means that most agents, if they're going to Home Depot and getting them a $100 gift card, they are only writing off a fraction of what they're allowed to, or they're writing off more than they're allowed to, and that's not a strategy that I would recommend, or anybody else in the room. So with Cutco, there's a cool little loophole here. It has all the information that your business card has on it, right? Logo, name, number. This can go legally in the category of advertising, and it's very easy to defend if you are audited. And so we've had agents they had to pay back taxes for the other stuff that they wrote off wrongly, but they got 100% discount right off on the Cutco. And the last thing that I'll share that we can do for you is create for you a system. I won't make you raise your hand, but everybody has run around the night before or the day of getting together a closing gift because you didn't get it done before. Everyone's had that moment of, do they drink? Are they lactose intolerant? What can I get done, right? We did a lot of expensive research. We did find out, guys, that every single one of your clients actually does eat. So at the end of the day, you can give each of them something to cut their food with, and they will use it. If you meet me in the back, I have a special for you today, and I'll explain that when you get there because I need to be quick. So rather than going through all the prices, I will just guarantee you that we can help you spend the same amount or even less, even though it's a high-quality product. We can help you spend even less than you're already spending on closing gifts, get the full tax deduction, and never have to run around the night before the day of the closing again. So come see me for your special. Thank you very much for your time, and I'll see you in the back during a break.
Great. Thanks, Lindsay. Yeah, definitely stop by Lindsay on your way out of the program today. Okay, so we're going to get started with today's program. So let me bring up Brian's slides here, and I'll welcome up Brian. Okay, So again, we're going to be talking about tax issues for realtors, and today to speak on that is Brian Harlander. Brian is co-owner of Keystone Financial Solutions, which is an accounting and tax consulting firm which specializes in tax return preparation for businesses and individuals, IRS tax debt resolution and representation, advanced tax planning strategies, QuickBooks consulting, payroll processing, bookkeeping, accounting, and financial statements. So without further ado, Brian.
Thank you, Steve. So thanks for having me back. It's good to be back here today. Let's see. Hopefully I can get this to work okay. Okay.
You have the clicker as well.
Okay, great.
Yep. You can just go
Forward
and backwards. You got it?
Okay, great. So as Steve said, my name is Brian Harlander. I'm with the firm Keystone Financial Solutions. Not only do we do tax preparation work for individuals and small business owners, but we also do tax resolution work, helping people who owe the IRS money resolve their tax issues. When they owe the IRS money, the IRS puts a lien on their property. We'll work with the IRS to get those liens removed so the client can have a clear title and be able to sell their home. This is what we're going to be talking about today, today's agenda. If you have any questions as I go through or you need clarification on anything, don't hesitate to raise your hand and ask. So we're going to start with the tax law changes that went into effect for starting in 2018. This is probably the most significant tax law change we've had in the last 30 years. And just about 10 days ago, the IRS rolled out the final regulations regarding their tax law. So everyone's been reading a lot in the last 10 days to find out the details. It's also important to understand that with this tax law change, it's what they consider a temporary tax law change. It runs from 2018 through 2025. At that time, it expires and everything reverts back to the 2017 rules, unless Congress extends it or passes a new tax act at that time. So what I'm going to start out with is for individual taxpayers, stuff that affects everybody, whether you're self-employed or a W-2 employee. The first thing the IRS did was they lowered the tax brackets for the majority of the people. This means everyone will be paying a little bit less in taxes based on which tax bracket they are in. Not only did they lower the tax bracket, but they also extended the range of income in each tax bracket that you can see that they're going to be taxed in. So what this means is everybody will be taxed, more of their money will be taxed at a lower income tax bracket going forward, which means additional tax savings for everybody. Each year, the IRS gives you a choice of taking the standard deduction or itemizing your deductions on Schedule A, and you can take the higher of. Under the new law, they pretty much almost doubled the standard deduction for everybody, going from $12,700 to $24,000 for married couples. This was an attempt to simplify the tax filings for a lot of people. Previously, the IRS has said that only about 27% of taxpayers itemize their deductions. With the new tax law, they're expecting that to go down to 15%. So one of the things that you can deduct on your Schedule A as an itemized deduction is taxes that you pay. State and local income taxes, real estate taxes, and sometimes sales tax. They put a cap on it under the new tax law of $10,000. This is probably one of the most publicized areas in the media, this part of it, especially for taxpayers that live in New Jersey, New York, California. States have high income and real estate taxes. They're complaining that they're going to be hurt worse than other people who live in other states with lower taxes. And even some states have tried to find a workaround, trying to get away from this cap. I guess one of the things that New York tried was trying to get people to make a charitable deduction to the state and then claiming that as a charity. and then the state would give you a credit back for your taxes. And the IRS said, no, that's not going to work. Charitable deduction, you don't get anything in return other than that nice warm feeling in your heart for the money that you gave. So usually you don't get anything back with the charitable deduction. This $10,000 cap on taxes does not apply to rental properties. So anyone has a rental property that is paying more than that, this won't affect them.
Did you say it does or doesn't?
It does not.
It does not.
Also in Schedule A, one of the things that you can deduct is the mortgage interest that you pay. Some changes with that. The IRS used to have up to $1 million worth of debt, and you could get the full deduction for your mortgage interest. For homes that were purchased in 2018 and later, they're lowering that threshold to $750,000. Everyone who's previously had a home prior to that is grandfathered in, so that will not affect them. It's just for new homeowners starting in 2018. If your mortgage is more than $750,000, there's a worksheet that you can go through so you can still claim some of the mortgage interest. You just won't get a full 100% deduction. And they, yes?
Sorry, can you define second home in that last slide? So the new law says primary and second. What's the definition by law?
It would be just a second home other than your primary residence that you use personally. That you're not renting out or using for like business purposes. Yes. One of the things that they did get away remove on the Schedule A was the miscellaneous deductions, tax preparation fees, stockbroker fees, the deduction for the safe deposit box that if you had one you could deduct. Those are all gone now. Alimony. Usually how alimony works is the taxpayer who is paying it gets a tax deduction, and the spouse who receives it includes it as income. Starting for divorces, starting in 2019, this year, it is no longer deductible, and the spouse receiving it doesn't have to report it as income. So anyone contemplating a divorce better talk to an attorney about it. They also eliminated moving expenses, except for military personnel, and they also eliminated the personal exemptions. Those $4,100 you got for every person on your tax return. They've gotten rid of that. For 529 plans and that you're putting your money in for college education, the only way you could get your money out of a 529 plan tax-free and without penalty is to spend it on college education. Under the new law, they'll allow you to take up to $10,000 a year out for K through 12. So you could take the money out and send your kid to private school or parochial school and use that money. They also modified the AMT tax. AMT is just an alternative way to make sure that someone pays the minimum amount of taxes in. They modified that so less people are trapped in that. So that will actually help to lower taxes for some people. They also modified the IRA conversions. They still have them, but there was a provision, I'll say maybe a loophole, that if you did not like the results of your IRA conversion, you could undo it by the due date of your return. They took that out, so once you do an IRA conversion, you are stuck with it. And Congress couldn't get rid of the health insurance penalty, the penalty for not having health insurance. So what they did was they just made it zero for 2018 going forward. So technically there's no penalty for anyone who doesn't have health insurance for them or their family. Yes?
On moving expenses, a lot of our transferees, the company pay part of that.
Mm-hmm.
How's that going to be affected?
That will probably be added to their compensation on their return if the company is paying for that. Yes, but they won't be able to deduct it on their personal return if the company isn't paying for it. The child tax credit. This is probably one of the best things out of the new tax law that for those with children. Under the old law, you got $1,000 per child as a tax credit on your return, but the credit started to get phased out at $110,000 of income. Under the new law, they doubled it to $2,000 per child, and the phase out for your income doesn't start until $400,000. So a lot more people will be getting this credit, and it won't be phased out for so many people.
That's for all this is for the 2019 year, not for people filing.
It's for 18, starting in 18. So when you're filing your return, next month and stuff, before the April 15th deadline, all these tax law changes will be applicable. Any questions on the individual stuff thus far? No? Okay, we'll move on to the business side. So one of the first things they did on the business side was they increased the amount of depreciation you could take for passenger automobiles. They defined passenger automobiles as those weighing under 6,000 pounds. This usually takes into effect for your sedans and maybe your small SUVs. They've always put limits on it. That's why a lot of taxpayers will choose an SUV or a truck to drive, because it weighs more than 6,000 pounds and they don't have these type of restrictions on it. But they have almost tripled the amount of depreciation you can take on passenger automobiles. So that should be viewed as a positive thing. They eliminated the entertainment expense starting in 2018. Sporting events, concert tickets that you might give out, entertainment of a client are gone. You can no longer deduct them. You can still deduct the meals. You still get the 50% for that, but just not the entertainment expense. And they also expanded the bonus depreciation and the 179 election. Usually this won't apply to people like you and me for these dollar limits. It's more for the larger corporations to help them, spend their money today to help stimulate the economy with their capital purchases. This is probably the thing that's also gotten the most press on the business side. It's a new 20% deduction for business owners for qualified business income, QBI, and it's available for flow-through entities such as S-corps and partnerships and sole proprietors filing the Schedule C. And you get the lower of the 20% of your business income or 20% of your taxable income. And of course, it wouldn't be the IRS unless they put some type of phase out on a deduction. So for those of us who are providing a service, if we make under $315,000 a year, we can take the full deduction. If we make more than $415,000, we're not entitled to any deduction. And if you fall in between those two numbers, you get a prorated amount.
So just to say this back to you, if
Yes.
you're not an S corp or is an LLC, or that's still
That will all apply. If you're an S corp, partnership, an LLC, regardless, as long as you're not what they call a C corporation, this will apply to you, and it
not
will.
like it's realtors if you're a nothing.
If you're a realtor as a nothing, this will apply to you.
This applies.
Yes, this applies to you.
Okay.
And is that gross, the 315 or net?
315 would be taxable income. So here's a little example of how it works. And in the first column, let's say you have a Schedule C filer making $100,000 a year. They take the normal deductions on the tax return, $7,000 for the self-employment taxes. They make a retirement contribution. They pay for their own health insurance, and they take the standard deduction. That leaves them with a taxable income of $53,500. The 20% of the business income is 20% of the $100,000 from their Schedule C, or 20% of their taxable income, which is 20% of the $53,500. So they get the lower of those two numbers. So this taxpayer would get an additional $10,000 deduction on their tax return. In the second column, everything's the same, but this taxpayer has other income. Perhaps they have a spouse that has a W-2, so they have an extra $60,000 worth of income. So their 20% deduction on their business income is still based on the $100,000 from their Schedule C. But since their taxable income is higher now, they get 20% of that. And they get the lower of those two numbers. So in this example, the taxpayer would get a $20,000 deduction additional on their tax return. It's kind of an oversimplified example here, but hopefully it gets the point across of how the qualified business income deduction works. Anyone have any questions regarding this?
If you look at 2017, would you pay more or less taxes in 2018?
For this, for 2017, you'd probably pay more taxes than this. If everything's being the same, you'd be in the lower tax bracket. More of your income would be taxed at the lower tax brackets, and then you're also getting an additional tax deduction here. I say lower because it also depends on whether you itemized or not. And if that $10,000 cap on your Schedule A that you're limited to, if that affects you, then you could be worse off. Through our clientele, from what we saw last year, probably 2/3 of them got a benefit of the new tax law, and about 1/3, everything was basically the same. It was a wash. So at least with our own clientele, we haven't seen anyone actually hurt by the new tax law. Not to say there couldn't be people out there that are in the worst situation. So a question for you guys, does the 20% deduction apply to rental properties that someone owns? Anyone want to venture a guess?
Probably not.
Probably not, yeah. Well, it all depends. That's the answer anytime someone asks you a tax question. It all depends. And it depends on whether the rental property is treated as a trade or business or for an investment. In the past, we never really cared so much whether it was a business or an investment. You just reported the income on your tax return, paid the taxes, and you moved on. The qualified business income deduction, it's business income. So if it's more of a passive investment that you have with your rental properties, the IRS is going to say that you're not entitled to that deduction. You got to be in the trade or business of the rental property. And in the past, the IRS has always said would look at the facts and circumstances of each taxpayer. You could have two taxpayers owning the exact same property, and for one, it could be a business, or for the other person, it could be an investment. And it also depends on how much work you're putting into the rental property. Do you do everything yourself, or do you outsource the work to maybe a property manager, a handyman to take care of all the repairs? The IRS will look more favorably that it's a trade or business if you're doing more of the work yourself in the rental property. One thing we did ask the IRS, the accounting profession, was to come out with some type of definition. And they came out with a safe harbor provision here saying for rental property owners, if you keep a separate books and records for the rental property, you put in more than 250 hours into your rental property, providing services to there, and you document it, we will treat you as a business for that. And for rental properties, you'd be entitled to that 20% deduction.
What would be an example of that? 250 hours, is that if you have some special needs or something and you're a case
That could be time finding a new tenant, meeting with contractors to do maybe a remodel. Someone moved out, you want to replace the rugs, paint the house. You could be actually doing the work yourself. That would count. Basically any activity that is for the benefit of that rental property, and just to document it.
Okay.
There's two parts that would eliminate the safe harbor provision, and the IRS says if you use the rental property for more than 14 days a year, you can't take the safe harbor provision. So if you got a shore house down at the shore that you use for 3 weeks and rent it out for the rest of the summer, you can't use the safe harbor provision. Now that doesn't mean that it might not still qualify as a rental property. It just says that you can't take the safe harbor provision. It also says that the triple net lease, if your lease contains a triple net lease provision, you can't take the safe harbor provision. Triple net leases are more common in commercial properties. It's where the landlord has the renter pay for the real estate taxes, the insurance, the repairs and maintenance. Basically, the landlord is wiping their hands of the property and say to the renter, you take care of it. It's your responsibility. And I guess they put that in there because if you're really doing that, you could not be actively engaged in the property because you're deferring too much of the work, because now it's the renter's responsibility to come up and fix the property when there's something wrong with it. Let's see. They also put a provision in the law for self-rentals. And what the IRS means by self-rentals is that if you own your own business, so my tax preparation firm, I own that, that's a business. If I happen to also own the building and I rent it to my tax preparation firm, that's what the IRS would call a self-rental, and they will allow that. They will consider that automatically a trade or business for that rental property, as long as it's commonly controlled. And they mean that I own at least 50% of the rental property, and I own at least 50% of my tax preparation firm. Doesn't matter how many hours I put into the rental property under that scenario, it's just automatically defaulted to a trade or business. So anyone that's running out to, I guess, a business that they own, this would be a favorable provision in the tax law for them. If you're going to say that you are in a trade or business to get the QBI deduction for your rental properties, the IRS is going to require 1099 miscellaneous forms to be filed for anyone that you're paying for services rendered. In the past, this never really came up, because if the IRS ever questioned you on an audit, did you file any 1099s for your rental properties, you would just say, no, this is just a personal property, it's an investment property, I'm not in a trade or business. But now in your personal return, if you're checking the box for that rental property saying, I'm in a trade or business, I want the 20% deduction, this is probably going to be one of the things they're going to be checking with their IRS computers to see if people are filing their 1099 miscellaneous forms. And they're due every year, January 31st, they got to be filed. And you can see the penalties could be quite high because it's per vendor. Does anyone have any questions on filing 1099s?
1099s used to be only for people that I think you paid over $650.
$600 that you pay, and it's to non-corporate vendors. So anyone that you pay that has Inc. or Corp. after their name, you don't have to issue those 1099s. But if they have an LLC, a partnership, or they're just doing business under their own name, you would be required to issue a 1099 for services.
In this case, is it anybody that you do business with, or is it anybody you pay over $600?
It would be anyone that you paid over $600 during the year and that performed the service for you. So if you had a property management company doing that, you would have to issue them. If you had someone come in and do the landscaping or on the snow removal, you would have to issue them.
So like if you need a new HVAC and you hire, Joe's HVAC, you need to check if he's got a corporation?
What you're supposed to do, like when you're an employee and you get hired at a new place, they make you fill out the W-4. When you engage a contractor, it's a W-9 you have them fill out. It basically gets their social security number or their EIN number if they're operating as a legal entity. Name, address, all that pedigree information, and that's your get out of jail free card, that W-9 saying, I asked them for it, they gave it to me, and I issued them the 1099.
Does that include fees like for HOA? if I own a property and I own a condo that I rent out and I pay a condo fee monthly, would that include that?
No, that would not include that. Any questions on the rental property QBI that you might have that might have been forming while I've been talking?
So are you saying that if the contractor was an LLC, was a corporation, you don't need to get the W-9?
If he's a corporation, no, you don't need to issue a 1099. If he is an LLC, I will say it'll depend, because an LLC is just a legal entity. It's not a tax entity. An LLC could be taxed as an individual. It could be taxed as a partnership, a corporation. So if they have LLC under their name, it's best to get them to fill out the W-9. One of the boxes on there is how are you organized, how are you taxed, and if they check the corporation box, then you don't have to issue it.
So getting the W-9 is going to tell you that.
Yes, getting the W-9. Get the W-9 before you give them the money. Yes.
1099s need to be out and back by January 31st?
Yes. Yes.
The safe
Yes.
harbor provision, I missed, is there any way that I could go online and like research that more? I sort of missed that. I was writing down.
Yeah, sure. I can go back for a second here.
The next one, yeah, that one.
Yes. So usually separate book and records. Some people have interpreted that to mean a separate bank account for the rental property, that you're just not using your own personal bank account that you do for your personal expenses, and document the time that you put in. So if the IRS ever questions it, you send it to them and secure your tax deduction.
Thank you.
This would be per property.
The 250 hours can be allocated to all of them. So yes, one property, it could be hard to reach 250, but with multiple properties, it does become easier. So we'll move on to audits. The IRS loves to audit realtors for the simple reason that you file a Schedule C. The Schedule C is probably the number one reason for the cause of the audits, just by adding that form to your tax return. I think statistically, it increases your chance of an audit by like a factor of 4. So that's why they love to audit you guys. We're going to talk about the types of IRS audits here. The first one is what they call a CP 2000 notice. This is something that you may have gotten in the mail. I'll say it's not really an audit, it's more of an IRS inquiry. The IRS has a matching program. So everybody who sends in W-2s or 1099s, it hits the IRS's computer, and they are matching that to your return. So if the IRS has something on their computer that you didn't put on your tax return, you'll get the CP 2000 notice. The common stuff is usually the stuff that's issued by a financial institution. Your interest, dividends, maybe a stock sale or something that happened during the year. Those statements get lost in the mail and you forget to include them in your tax return. That's what generates this notice. Now, if you agree that the IRS is correct, yeah, I omitted this, it's usually very simple. You check the box on the notice, you mail it back with your payment, and it's completed. If you disagree with the IRS, since it's a correspondence audit, you have I'll say a pen pal with the IRS for a couple of months. It'll take them a while to adjust it and get your account cleaned up. This is probably the most basic common notice that is sent out by the IRS. Has anyone ever gotten a CP 2000 notice out there? No? Good.
When you say payments made by the taxpayer, so those are tax payments that we're making?
Usually those notices are generated by estimated payments. Maybe you were told to make $1,000 each quarter, and for whatever reason you forgot a quarter, but you put it on your tax return that you made all 4. The IRS is going to say, no, we're only showing 3,000, not the 4, and provide us with the canceled check or your bank records to show it. Otherwise, just pay us the balance due with a notice. Yes.
What is the IRS penalty for under paying your estimated taxes?
For anything that's
If you don't do your quarterly.
for underpayment, it's usually 0.5% a month. It's about the same, yes. Yep. Question in the back.
Could you play the slide with the Schedule C?
Back there. Sure.
So, are you saying that the IRS loves to audit realtors who prepare their own tax returns versus having someone else do it? Is that a flag for that?
Well, I think realtors prepare their returns more so than other self-employed people. And they might not be aware of all the tax laws and changes and requirements. So it's usually with the IRS, it's low-hanging fruit. If you know people might not be up on everything that they're supposed to be doing, they'll tend to target those people.
Question.
Yes.
Any advantage to filing an extension? Does that reduce the risk of an audit? I've heard that.
So the question was, if I file an extension and I file my return in October, will that lower my chance of an audit? And I'll say, I don't know. That is a rumor that's been floating out there for a long time, that the IRS you could escape the IRS audits if you file an extension. I can't say it's 100% true. I might say it's more likely than not that you could escape an audit. But when people do that, they usually are procrastinators to begin with. So they won't give their tax information or start preparing their return until October. Then, as self-employed people, you could have a balance due. Then that money was supposed to be paid in April. If you're going to go that route, it's best to have your tax return prepared now and just sit on it. If you have a balance due, pay it by April, but then not file the tax return until October. That way you're current with all your estimated payments. Any balances that you had with your tax return are paid, and maybe then you can escape an IRS audit. That's a good question.
Are you going to talk about the home office?
Yes, I am.
For the filing an extension, is there any penalty apart from this, whatever the taxes you owe?
Well, the IRS has two penalties in that regard. There's a failure to file penalty and a failure to pay penalty. And the failure to file penalty is 5% a month, up to 25%. And as I said, the underpayment, the failure to pay penalty is 0.5% a month. So you're always better off filing and not paying than the opposite. But as long as the extension is for filing your return, it's not for paying your taxes. The taxes that are due are still due on April 15th.
Just back to the quarterly payments. If you submit all the money by the end of the year, but not necessarily at the time that you incurred the income, is that, how does that?
So on your return for a Schedule C filer, the IRS would just assume that the income was earned equally throughout the year. So they would put a penalty on that. Now you can go through the return and actually put the income that you earned in the quarter that it was earned, so it matches up. And that, if your tax software is showing a penalty by, I won't say manipulating your income, but putting your income when it was earned and when you made the estimated payment, could wipe that penalty out. Yes.
What about the required IRA distribution that's done in October?
The distribution?
Yeah.
So for being over 70? Yes, for being over 70 and a half. So once you reach 70 and a half, the IRS says your retirement plans, you got to start taking money out of that. And so that the extension you file for your tax return does not affect that mandatory distribution. You still got to take it out when you're 70 and a half. There's no extension granted for that. That's just for filing your tax returns. Yep.
I may have missed this, but as independent contractors, can we deduct financial advisor fees and tax prep fees?
It depends. It depends how they break out the invoice. If they put it out that it's for your Schedule C business, that you were asking a tax professional for tax advice regarding your Schedule C, they break it out there, then you can put that on Schedule C as a deduction. That's fine. But you can no longer put it on Schedule A. So I'll say since you're an independent contractor, self-employed, you'll still be able to get that deduction. It's just for maybe W-2 employees that won't be able to claim that deduction on Schedule A. But it seems like you would be okay.
But do they have to say it would be for?
It would be better that if they just, the IRS has taken the position, if they just put tax prep on the invoice, that also applies to the whole return, and the IRS could deny it on an audit. I've seen them do it. But if they break it out and they say, well, $100 is for the 1040 and $300 is for the Schedule C and your business, I've seen the auditors allow the $300.
And the financial advisor fees, or the financial fees for like somebody that just does your accounts for you?
Those are no longer deductible under Schedule A. I think you would have a hard time arguing that that's a business expense for Schedule C. So I would say, no, you can't deduct that anymore. Yep. The next type of IRS audit is what they call a correspondence audit. The IRS will mail you a letter, and they're looking for additional support for items that you claimed on the tax return. The most common are the tax credits that you claim on your return. Earned income, child tax, daycare credits. We saw a lot last year with educational credits, claiming the college tuition expenses. Tax credits are probably the #1 area where the government gets cheated out of money, I'll say illegally, by people claiming credits that they're not entitled to. Some of us, they just don't know the tax law, so they put the information down and it turns out they're not entitled to it. And also deductions outside the norm. What I mean by that is the IRS has statistical information in their database. So for someone making $50,000 a year, their system could say that the average charitable donation on a tax return might be $2,000. And you put a deduction down for a year of $20,000. That's going to set off the bells and whistles at the IRS saying this is outside the norm. You'll probably get a correspondence audit saying that provide us the support with that deduction. Now it might be all legit. We saw this one time where the person inherited like $250,000 and they wanted to donate $20,000 to their church. But it did set off bells and whistles. It was no big deal. They just sent in the canceled check with the notice they got from the charity, and the audit was closed out. I had one myself a couple years ago. I had a lot of medical expenses that weren't covered by insurance, and I claimed them on my tax return, and I knew based on the dollar amount of those deductions that I would be getting a correspondence audit in the mail. I did wait until October to file my return, and I still got flagged for it. But wrote them a nice little letter back telling them what the medical conditions were and put in some receipts for the big ticket items. It was closed out, no change. They were happy. The next type of audit is an office audit. This is what probably is more traditional in people's mind of the typical IRS audit, where you get the letter, they tell you to come down to their office with all your financial information, and they will go through it. In the letter, they won't audit everything on the return, but they will send in the letter the areas that they want to see support for, that they have questions about. and you have to go down to the IRS audit. I would recommend in these type of audits that you never do them yourselves, that you hire someone to represent you. Too many times I've seen people, I always think of those cop shows where they have you in the holding cell and they're asking you questions like you're, their best bud, and all the questions are leading questions used to trip you up, and anything you tell the auditor, just like the cops, are going to be used against you. So it's better to have representation with you. And sometimes I've seen people's responses expand the audit to different areas. And also, if they don't like the support you don't have support for certain areas, that could expand the audit to prior years too, saying you don't have the support in the latest years, we'll go back to all the open years and audit them too. So you want to try to get some help and minimize those type of audits.
How long does that audit typically take? Yeah.
You could be in there for actually a couple of days. Usually they'll have 1 day at a time, but depending on the complexity of your return and what they want to see, you might have to go back for a couple other days. I'll say the audit could take months from the time that you actually get the letter until it's closed out, but maybe just a couple of days of your time. This is what I would refer to as the audit from hell. I would not recommend this type of audit on anybody. The whole purpose of this type of audit is for the IRS to update their computer system, all that data in there. They choose these, there's about 150 million returns filed a year, and they usually perform these audits on like 50,000 people a year. So it's a very small number, but they do audit every line on your tax return. And I do mean every line. You put your spouse's name on there. They want to see a marriage certificate proving that you're married. Yes. You put your children down on there. They want to see a birth certificate for your children. And they use this as their guide to how to audit people. Because if they find mistakes with your return, it's quite possible that statistically 1 million people are doing the same thing. And so it's a real bad audit. I've only seen one person be subject to this in my time. It's very frustrating. So part of the easiest way to preserve your tax deductions on an audit is to keep good records of your expenses. Your expenses are a matter of legislative grace, and the taxpayer bears the burden of providing support for the deductions claim. The question we usually get is, how long do I keep my documentation for? You get that question a lot. Well, you should at least keep it for the open years that the IRS can go back and audit you. So if you filed your return on time, the open years right now are 15, 16, and 17. So definitely I would keep all the supporting documentation for those years right now. There's some things that you might want to keep longer. Anything that you're still currently using, like if you purchase an automobile and you're still using that in your business, I would keep the sales ticket for that. A house, I would always keep the settlement sheet for as long as you own the house, whether it's personal or rental property, because there's important tax information on there. And the IRS does not accept estimates on your return. Yes?
This may be a little bit off subject, but there are individuals that are aiming their parents or grandparents when they're doing it as a caretaker. For example, like I have my mother 1 year, and my sister has my mother 1 year, and you're claiming your mom on your taxes. How does that affect you with the IRS putting up a flag or anything in that sense?
Well, if you get flagged for an audit, I guess the question was if I'm claiming my parent as a deduction. I take care of them 1 year, and my sibling takes care of them another year. If you're trading off the expense, well, how does that work if you get audited? The IRS, if you claimed them in the year that you got audited, the IRS would look for support, just like any other dependent that you would put on there, that you paid for their, the majority of their support. You're taking care of them. As long as you can document that, it should be fine. The fact that you're trading them off year to year doesn't really set off red flags with the IRS. They see that a lot, not only with parents, but with children, based on the divorce decree, that the divorce agreement says I can claim them 1 year and my spouse can claim them the next year. So just by trading the dependent off each year shouldn't raise any red flags. Was there any other question there? Okay. Yes.
For documentation for meals, can you share what's the ideal situation?
Well, everything on that you get from a meal on the receipt is there. The time, the place of business, the dollar amount. The only thing isn't is who you met with and what you discuss. So I would just turn that receipt over and write, the Jones family and what you discuss, the homes that you discuss after showing them for the day. That's usually the easiest thing. And you can just staple that to your credit card statement and you got the support for it.
So the credit card statement isn't good enough to show that?
Not for meals. For meals, there's certain areas that have, I'll say, heightened scrutiny regarding support. Meals, automobile are among the high ones there. Yes.
Have you found that most credit card receipts today start to fade after a year, even less
Yes.
than that? I was audited. Part of actually I ended up getting more money back from them because I underestimated, which was good in my situation. But it was really difficult actually going back because it was year 3, the farthest year back.
Mm-hmm.
So providing all those, you could barely see. Then, of course, I didn't have credit card statements because they were all electronic, so then it took a whole lot of time. So I went back to paper, basically, to getting paper statements so that I wouldn't have to do that again just in case.
Yeah, I'll say, usually the restaurants are bad with that, with
all
the paper.
Receipts,
really? There's all of them?
Groceries.
Okay.
They all, because I keep them all.
Most of that carbon paper kind of stuff, that does fade. I know some people who just scan them in. Other people will take a picture with their phone, I've seen.
You have a lot of your clients doing the scanning?
They just do it as a matter of a fact. Yes. Well, that will show the date and the meal, but it won't show who you met with and what you discussed. So if you want to maybe keep a separate note on that, or if you're keeping an online calendar and on the date you mention that, hey, I took them to lunch and we discussed the following, that would be all valid support then.
I write it right on the statement when it comes out.
Yeah, you could do that.
Well, the IRS made me provide the receipt and statement. Well, one was not good enough. It was not just a receipt. It was not just a statement. I actually had to do both, and it went on for like a year and a half.
I'll say that when you do get audited, the most important determination is who you get assigned as the auditor. There are some very decent people out there who work with you, and you just get those who are hard as nails and will stick to the letter of the law, maybe not the spirit of the law. You also get those who might be maybe a year away from retirement and just coasting, and you get those who might be young trying to get promoted as quickly as possible. The success of an audit usually does come down to who you get assigned as an auditor and that working relationship. Yes?
Just clarify the auto mileage deduction. I don't do my taxes, so I'm not familiar with it.
So for deducting the automobile expenses, you're allowed actual or taking the mileage rate that the IRS gives you each year. If you need to keep track of your business mileage, where you're going, the date, the location and the mileage of each trip. You can keep that on a paper log. You can use an app for that. And you also have to have the total mileage for the year. I know some people subscribe to Carfax, and every time their vehicle is serviced, the mileage is reported to Carfax. So they can download that information, at least to get the total mileage for the year. If you're ever audited, I have seen IRS agents accept the Carfax report as the total mileage for the year. But for all those trips in between, some people will construct it from their calendar, that they know who they met with on their calendar. They're usually Google Maps will provide you the mileage in there if you put the address of the person that you're going to. So I'll say it's easier in today's electronic world to keep track of your mileage than it was when everything was just paper-based. If you're claiming actual expenses, you still need the mileage, because unless you're driving 100% for business and never using your car for personal purposes, you won't get 100% of those deductions. If you've put 15,000 miles of business miles on and drove the car 20,000 miles total for the year, that's 75%. You get 75% of all your actual expenses. So that's how it works. But in both cases, you do need to keep track of the business mileage and the total mileage.
So do you have to include like going to your office for the first meeting of the day? Or like, let's say you just have one client meeting in a day and you just go there and you come home. That counts. So it's not the whole thing where you have to, like years ago, it seems like you had to deal with like the first trip of the day was like to your office and then like the subsequent trips.
Well, we'll talk about that coming up with the home office, about the commuting expense.
I travel to a place where I'm interested in investing, but I take my wife and we also turn it into a long weekend. How much of that, like what do I have to provide to save this business trip? And what, is it only my expenses that are deductible?
The primary purpose of the trip has to be business. So most of your time would have to be spent on business to deduct the trip. So if you went down the shore and you looked at potential houses for one day, but spent the rest of the week there lying on the beach, the IRS was going to say, that wasn't business. That wasn't predominantly business. If you went down there and you spent 2 days looking at properties and a day relaxing on the beach, then more than 50% of the time would have to be on business related to have it be as a business trip.
How do you prove? I mean, if I went to a real estate conference in San Francisco, and that was a 3-day conference, but then spent 2 more days, I can show itinerary to the conference.
You have the
itinerary. How do I do that if I go to, the Cayman Islands?
Well, the business, if it was a conference, you have the itinerary, you have the credit card charges from the seminar, that's proof. If you're looking at, let's say, rental properties, you go down to the Cayman Islands and you're looking at rental properties, then you keep note who you met with. Did you meet with a realtor down there? The pamphlets of information they give you on each property, keeping that. I'll say the burden of proof is more on you then, but it can be done, yes.
What is the auto mileage deduction, and would you recommend that or the expenses deduction?
It all depends on which is higher. Realtors put a lot of mileage on their cars, so I've seen most people just take the mileage deduction.
And that is this year?
Like 54 cents a mile, something like that.
So it hasn't changed.
It usually changes each year. I forget what it is for 19 coming up. I think it was like 54 cents for 18. Also, if you're getting a new car, you're going to have less repairs and maintenance with that. If your car is 10 years old, you could have more. So taking actual could be beneficial.
They increase the depreciation, right?
Yes.
On our cars.
Yes.
So that might make that more attractive.
It could. basically have to look at it both ways and take the higher amount. That's I'll say the simplest explanation I can
But
give.
once you make a decision on a car, if it's a 2-year-old car, you can't flip back and forth.
You can flip back and forth if you claim the mileage in the first year. If you take actual expense in the first year, then they don't allow you to flip back and forth.
What is the kind of min-max for automobile percentage business use in regard to IRS? Do they?
You mean what's going to set off their computer system?
Yeah.
Say 100%.
Yeah.
That people claim 100% all the time, and that usually will flag it. Usually estimates when on the computer software, they'll ask you how many miles did you drive for business, and everyone puts in like 10,000 exactly. Well, that sends off a message to the IRS that this is an estimate. It's not exact. Putting down an estimate would be more likely to get the IRS's attention rather than just claiming maybe it comes out to be 82%. 82% might sound high, but if it's a legitimate, there's no reason not to put it on the return.
What if you have two vehicles? So you have your 100%. What would you have to prove for your second vehicle that you use for personal use? In other words, if you were using your work vehicle for work.
So if you have one vehicle you're saying that you use just for work, and the second vehicle is just for personal pleasure. So for the one used for personal, you don't have to prove anything with that. The vehicle that you're using for business, you still got to prove the same amount. In that case, your business mileage will equal the total mileage for the year. So that your mileage log should tie into, I guess, the odometer reading for the year of how much mileage you put on that car. And
so you wouldn't have to show the odometer reading on your personal vehicle to thereby prove that you've used.
Some people do that. Some people do that. Some people also, when they get their oil change and car inspection, they put the mileage on that. They'll take that receipt and keep that with their records. And a lot of the auto mechanics report it to Carfax. So if you're not keeping track of it and you do get audited, Carfax is a great place to go to get that odometer reading. Yes.
You may be familiar with showing time, which is the system we use to record all the transactions that you make.
Okay.
You go in and print out a log at the end of the year of all of the showings that you've had, and can that be used as your mileage documentation instead of having all the little receipts and logbook?
I guess if it's showing the date, the location, you can always calculate the mileage, I guess. I'm sure it's not doing that for you, but that could be definitely support for it, yes. Okay. We talked about estimated payments a little bit earlier. The taxes is due when the income is earned. There's no real magic dates through the 15th of April, June, September, and January. Those are just the due dates. You can remit money anytime you want. The IRS is always glad to take your money. We do have clients who send in estimated payments monthly. We have some who do it after each commission check they get. Whatever works for you, just make sure that the IRS is getting the money. You can remit it. You have to use the paper vouchers. If you don't want to, you can remit it online. You just put in the dollar amount, your bank information, and which tax period you want to apply it to. It can be done in like a couple minutes. Very nice. Yes?
Question about the refund from the previous year
Mm-hmm.
and this quarterly tax payment.
Okay.
So, for example, if you have a refund for $5,000, you don't take that, but you just keep it. And every quarter you pay a certain amount of money. If you have more income in one of the quarter and that does not compensate, do they use that refund money?
So I'll repeat that question. So you get a refund on your tax return, Can I apply that refund to my estimated payment for that quarter?
Right.
Yes, you can. If it's sufficient enough to cover that first quarter, yes. If it's not, then you still might have to pay in a check for the balance due. I've seen some people where it's a very significant refund and it covers multiple quarters going forward. So yes.
Can you pay your quarterly with a charge card?
Yes, you can. They will. The IRS will charge you that service processing fee. So if you're trying to do it for the points, you might not be coming out ahead, but you can. We're going to talk about the home office. Home office is nice because you're turning personal, non-deductible expenses into business expenses. There's 4 tests that you got to meet to claim the home office. The first one is you're engaged in a trade or business. This is pretty much the easiest test to meet. This is your business. You got a profit motive. Second test is your principal place of business. A business can have more than one location, but to get the home office deduction, your home has to be your principal place of business. The IRS will look at the importance of each activity that you perform if you have more than one location, and they'll look at the time you spent and the activities. The third test is regular use. You must use your home office on a regular basis. The only time you're working from home is when the kids are sick with the flu. The IRS isn't going to allow you the home office deduction. And the last test is exclusive use. That room in your house that you're using for your home office, or the portion of a room, has to be used exclusively for business. That means the kids aren't doing their homework from that office space when they get home from school. Your spouse isn't paying the bills in the weekend from that same space. Those are the 4 tests, and if you qualify, you can claim the home office deduction. Some of the expenses that you can take here, the top 3 you get automatically as a homeowner: real estate taxes and mortgage interest, even the PMI. The ones below the lines are non-deductible expenses that now you can deduct for some additional savings.
Wait, say this. The ones below you can now deduct?
Yes, as a home office expense. Yeah, you're not allowed to deduct your home owner's insurance policy on your personal return, but now since it's a business purpose, you can deduct that.
But you have to do it by square footage?
That's one of it. So if you're only using 10% of your home as a home office, you get to deduct pretty much 10% of your expenses.
So if I repair a bathroom, if I renovate a bathroom, is that part of the home office?
It depends on whether it's...
I have to use the bathroom to work in that office.
Yes, you do, but the IRS would say no for a bathroom unless it's, I'll say, exclusively. Like some people they might have a bedroom on the first floor and they use that as an office. Yeah, if it's used exclusively for that, you can claim that square footage deduction. But if you're not able to claim the bathroom there, then yeah, you're not going to be able to deduct your water bills and stuff like that because it's not going to be exclusively used.
So just so I'm clear,
Yes.
you can only take these deductions if you use your office primarily, if that's home
Yes.
office. But if you use it 10%, 20%, you cannot take these deductions.
Yeah.
So what's the percentage? So just say a security system is $500 a year.
You're paying whatever percentage of, so if you're using a 20 by 20 room in your home, 400 square feet into your total house of 4,000, that's 10%. You get to deduct 10% of your insurance, your repairs, utilities, plus you also get the depreciation on top of that.
So let's say the repairs and maintenance section, say that just that home office, you did some repairs and maintenance,
That's correct. If you do direct repairs to that home office in the room, you paint that room to make it nice, you replace the carpet in that room, you can claim 100% of those expenses directly related to there. If you replace the carpet in your whole house, then you would be limited to that percentage.
And that's true, I guess, you have to have a heater, so percentage of that.
Percentage of that, yes. Yes.
Just touch on the ramifications of selling your house. I'm deducting it for 3 years.
Mm-hmm.
Now I get the depreciation aspect of that for those 3 years. What does that do when I go to sell my house?
It doesn't affect the $500,000 home exclusion. You can still sell your home and use that code section to exclude the gain, but you would have to recapture the depreciation expense. There could be depreciation recapture expense by claiming the home office and selling it. But if you're going to claim the home office, you have to take the depreciation. You can't say, well, I won't claim it because I may have to recapture it. Depreciation laws are written, it's worded and such. It's depreciation that you're entitled to or you claimed. So even though you might not claim it, thinking that I don't want to recapture it, the IRS would make you recapture it.
So what are you depreciating? The total value of your
Total value of the house. Kind of like you would for like a rental property. Yep. You should contact your insurance agent to make sure that you're covered for a home office, especially if you have clients coming to your home, and the travel expense. Without claiming the home office, your commute from your home to maybe your broker's office is a personal commuting expense. Now that you're claiming the home office, that's going from one business location to another business location, and that mileage is deductible.
Question.
Yes.
Is having clients in your home important as part of the deduction?
That's might be one of the things the IRS looks at. I know some brokers, they won't charge their realtors an itemized thing for rental space. They don't provide rental space. So in that situation, you might not have an office to go to. So your home office is your home office. Just because you're not meeting with clients there doesn't mean that you don't qualify.
I have a question.
Sure.
About the 2018 real estate. You said if the home is purchased before 2018?
That related to the mortgage interest. So if your home was purchased prior to 2018, you don't have a limit on the interest deduction. You just have a limit on the total debt of $1 million. If you purchased a home in 2018, then your debt limit is $750,000 to claim the full interest deduction. Or were you thinking about the real estate taxes?
Yeah, that's what I was thinking.
Real estate taxes? Yeah, for this year, when you file your return this year, you would be limited on your Schedule A to $10,000 of taxes, whether that be real estate taxes, income taxes, sales tax.
Regardless of when you bought the house?
Regardless.
Oh, okay.
Yes.
Is
Yes.
that per house?
Excuse me?
Is that per house, 10,000 per house?
No, that's total. Total on
If
the.
3 houses, you go in like 10,000.
Correct. Yes. But are those houses are they all personal? If you had 3 houses, are they rental properties?
Second home.
Okay, if they're a second home, yeah, then you're going to be limited. But if the one's a rental property, it's reported on a different schedule and it's not applicable. Your question?
Yeah, so that was my question, but just to elaborate more, are you saying the rental property taxes will go into the different schedules, not in the 10,000?
If it's a personal home that your primary residence, maybe a vacation home for you and your family, all of those taxes, the real estate taxes get reported on Schedule A for itemized deductions. If it's a rental property, those taxes get reported on Schedule E. Schedule E, there is no cap on the amount of real estate taxes that you can claim.
Just to repeat.
Yeah.
Just to repeat. Second home, vacation property, not rented. We cannot take a deduction for the mortgage or for the taxes.
You can.
Compared to sales.
The taxes are going to be limited to $10,000 combined for your primary and vacation home, and the interest will be deductible as long as you don't go over the $1 million of debt. Because I'm assuming that you've had the houses prior to 18. Mm-hmm. So you might not be itemizing this year. You might be taking the higher standard deduction, maybe.
Which is how much?
For a married couple, it's $24,000. Yep. Yes.
I have a question regarding entertaining and marketing.
Okay.
So if you have, say, a pie party that you invite all your past clients to your house and kind of thank them for the business, is that a marketing expense or is that a entertaining expense?
It would be a meal expense.
So it would only be 50% deductible?
Yes. I'm going to move on to assignment of income. Most realtors properly report their income and expenses on Schedule C. Some people report it on an S-corp return. If they don't do it properly, the IRS will disallow it, and they call this assignment of income. That corporation is a separate person, let's say, and you can't assign your income to another person just to reduce taxes. The sole reason for this is your real estate license is in your individual name. It's not in the name of a corporation. Does anyone have any hint of why someone would want an S-corp, to form an S-corp and report their real estate commissions?
Does it protect your assets?
Liability.
It could be. Liability could be one reason. Any others? Yes.
So I was thinking, like when you hire someone, you can set up payroll or something on that.
Now you could still set up a payroll without having an S-corp, but the main reason that people set up an S-corp is saving of taxes, in particular payroll taxes. Here's a little schedule here. Two taxpayers, one's a Schedule C. They both make $100,000 a year. The S-corp, they're $100,000. They pay themselves $60,000 in a W-2 as their salary. The other $40,000 comes through as a distribution. Still made the same amount of money, and you can see they all pay the same amount in taxes, except for the payroll taxes and the local taxes. That's because the payroll taxes are for the Schedule C filer is based on their Schedule C income, but for the S corporation, it's only based on the W-2 earnings of $60,000. So this is, I'll say, the main reason why some people want to be taxed as an S corp. There's a potential for tax savings. Yes.
So, some brokers won't pay an S corp their commission. They won't direct deposit it into an S corp account. It has to be into the actual realtor account.
Yes.
So in that case, I guess my question is, what can you do as an agent if you're paid directly and then you create this S corp?
I'm going to take care of that on the next slide.
Can you be a separate entity and be listed?
No. You have to form an S corp. Either you form an LLC and elect to be taxed as an S corp, or you just form an S corporation directly. But how do you get your commissions reported to an S corporation? First, you got to form a qualified associations. This is relatively new. It's about 10 years old now. It permits brokers to pay the commissions and issue a 1099 in the name of the S corporation and not in your individual name. This is the legal way you get around the IRS challenging of where the income should be reported here. And then you'll have a filing with the Department of State and the Department of the Real Estate Commission to form your qualified association. And once you form the qualified association, then you can form your corporation or LLC, and you can be taxed as an S corporation if you so choose. But
There's fees for that.
yeah. So the one requirement is that you get your brokers, you got to get your broker to sign off on it. A lot of brokers won't sign off on it until the beginning of the year for their own accounting records. They don't want to issue which commissions during the year get paid to you versus the individual. They got to issue 2 1099s then. I've heard a lot of them say, well, I'll sign the paperwork, but it will go in effect January 1st of the next year. So it's a conversation to have with the broker.
So if the broker still won't.
The broker won't sign off on it, then you cannot do that. Get it paid to the S corp. I'll say legally. The IRS would challenge that, and very severe tax ramifications there.
Are there lots of realtors who are S corps?
I would not say a lot. There are a few. Some form partnerships also. They like to work together, pool the commissions, and split the expenses. But yeah, I've seen, I would say maybe about 10% of them are using like an S corp or a legal entity.
So is there any tax advantage to an LLC at all?
There is no tax advantage over, I'll say, like an LLC being taxed as a partnership compared to an S corp. You'd pay the same amount in taxes being taxed as a partnership versus just on your Schedule C.
Then what's the benefit of it?
Legal liability protection. Any other questions? So it's 11:30. That's it. I have more stuff I can talk about, but I don't want to hold you up if you. Sure. I would say at least 3 years. That would be the minimum, I would say, because those 3 years is typically the time the IRS can go back, 15, 16, and 17 right now. That's assuming that you filed your returns on time and the statute of limitation is running.
So how long do they, when can you be relieved that you haven't been audited for any given year? Like
After 3 years from the date that you filed. So 14 is closed. The IRS can't come back. Well, as long as you didn't commit fraud, did anything illegal in that year, then that year is closed. You can rest assured. The IRS can't come back and say you owe us money. Those years are closed.
For those of us that can stay, are you able to go through the rest of your slides or no?
Yeah, I can spend another 20 minutes or so. Yeah.
There's that many slides?
Yeah.
What was the question? I'm sorry.
We didn't get through the slides.
So he was asking, can I stay a little bit and go through the slides? Yeah, I can stay for another 20 minutes or so. But if you guys need to leave, you can go ahead. You're not going to hurt my feelings. Yeah. Once again, it all depends. Depends on your other income. Social Security is either not taxed at all, taxed up to 50%, or 85%, all depending on how much other money that you have. So if Social Security is the only income that you have, it won't be taxable to you. If you have other sources of income, still working, your rental property, you're doing this, then it could be taxed 50 or 85% of the dollar amount you receive.
Thank you.
Thank you.
Thank you for coming. Thank you.
Are they deductible for rental property?
The assessment?
Yeah.
You mean the taxes?
No, the assessment, the assessment for a couple of years, the rental property. Special assessment, that's
That would go into the basis of the property. Is that, what do you mean by the assessment? Are you talking about?
Condo association special assessment.
Okay. Yes, those types of fees you can deduct. The condo HOA fees, the special assessment.
But not on your personal residence, it's condo owner. Only
No,
on a rental property.
only on a rental property.
Very good.
Yes.
Is there an advantage to have a lease car instead of an owned car?
Only advantage could be your own financial, like it's more economical. There's no tax advantage whether you're leasing it versus purchasing.
Thank you.
Yes.
What about your health expenses exceeded?
Your healthcare expenses?
Yeah, what, just regular expenses? Like
Okay.
this.
So she mentioned about your healthcare expenses, whether that exceeds 10% of your income. That's to claim it on Schedule A as a medical expense. That's one of those itemized. You still can, but as self-employed people, if you're paying for your own health insurance, you can deduct that right on your 1040, right on the front of it. You don't have to itemize to deduct it for self-employed people.
Just the health insurance, not your actual expenses.
Correct, just the health insurance part of it. The actual doctor co-pays, that has to go on Schedule A.
Medicare too?
Yes, for the Medicare, you can deduct that, yes.
Lady asked a question about how far back do I have to worry about being audited or have to keep records. If I actually get audited, and you mentioned fraud, but let's say I misapplied a law and I'm doing my taxes myself, can they say, well, this is not technically fraud, but this is something that we want to go back and look at previous, outside of that 3 years, can they do that?
Under very limited circumstances. They would have to audit you something in one of the open years, and it would have to be a substantial change to your tax return to go back there.
Okay.
I would say as a general rule, you are safe after the 14 is closed now. So if you filed your returns, you could probably sleep tight knowing that 14 is okay.
And you said it all depends on the auditor that you get. Is there a way to switch auditors?
No.
Once you've signed that,
Good question.
The only way you can switch it is on their end. They have come down with a medical problem. They need time off. They will reassign it. The IRS will reassign an auditor based on caseloads and stuff. But you cannot pick and choose your auditor. Yes.
So are health insurance premiums deductible or just expenses?
The health insurance premiums. Yes. Yes.
So has anything changed when someone sells a home, the capital gains are deferred up till, and like, when does it end? And is it, they do have to buy a home within 2 years? Is that still true or not?
I think you're confusing the two laws there. So on your personal home, as long as you lived there and it was your primary residence for 2 years, you can sell that home, and if there's a gain, the first $500,000 of the gain is excluded from income.
Forever, like you don't have
Forever.
to track.
You can keep doing that every 2 years. So you move, you spend 2 years, you sell it. As long for a married couple, the exclusion is $500,000. I think the other thing you're thinking about when you sell a rental property, that if you hold it for longer than a year, it's considered capital gains, and you get taxed at those rates versus the ordinary income rates.
Gotcha. Okay. So didn't there used to be a law about you had to buy something again in 2 years of personal residence?
I think you're thinking of a like-kind exchange. That when you, yeah. So when you're selling that rental property, you can defer the gain on that. Yeah. You guys have a nice lobbying group on your behalf. You guys get.
And when someone buys a home that year, what is it that they get to deduct?
You're talking about a personal? residence?
Personal residence.
Personal residence.
Are you talking about points? Yeah, I mean, is it points and all that?
Well, in addition, see, that's why you need the settlement sheets, because on there, they will list the taxes, the real estate taxes that were paid by the seller and the buyer, and so some of those are reported on there that aren't reported on the 1098 statement. You can deduct the points, the PMI insurance on your tax return. That's about it. Everything else gets included in the basis of your home. So the real estate transfer taxes, that goes to the basis of your home. Yes. So for real estate investors, there's many advantages to being a real estate investor. We were just talking about like-kind exchanges, that if you sell the property and buy one of equal or greater value, you don't have to pay the gain on the sale. Capital gain treatments, you will get taxed at a lower rate if you hold the property for longer than a year. Probably the biggest disadvantage is that your tax losses could be limited for your rental property. And there are different types of, I'll say, limits that the IRS puts on your deducting of losses from your real estate. The first is what they call a passive activity loss. This is when you don't participate in your rental property at all. You might hire a management company to do everything for you. The only thing you do is cash the checks. The IRS says if there is a loss in that year, you get no benefit for that loss. You don't lose it. It will just get carried forward until you sell the property or until you start generating income on that property. The next, I'll say, threshold is an active participation in the real estate. You do some of the work, but maybe not all of it. The IRS will say you can deduct up to $25,000 in losses and apply those losses against other sources of income that you have. But of course, there's limits on everything. If your income is below $100,000, you'll get the full $25,000. And then once it gets above that, you get a partial deduction, a prorated amount until you reach $150,000. And then you don't get any deduction again. Once again, you don't lose that deduction. It will just get carried forward for you. Yes?
On the 2-week vacation rule, can't you go into clean and pay past that 2 weeks?
Yes, if you're going down there as I'll say the landlord, you're not using it per se, but you're fixing it up and making repairs to it, that's okay. The third type is real estate professionals. There's no limit on the losses, and the question is, how do you qualify as a real estate professional in the eyes of the IRS? We once had a client come in who he said he was a retired real estate professional, and he just kept his license active so he could claim he was a real estate professional. He owned 4 properties. They were all located in different states, and he didn't do any of the work. He had a management company do everything. And we're saying, well, let's look at the rules for a real estate professional. And the first test is that you materially participate in each of the property. Since the guy had a management company that performed everything, he didn't meet that qualification. You got to put in at least 750 hours in real estate business. That could be your rental property, and that could also be your selling homes. That would count towards that 750-hour test. And the third test is more than half of the services you provide, of all the services you provide, have to be in the real estate business. Just simply having a real estate license won't qualify in the eyes of the IRS. So it's possible that I could be considered a real estate professional in the eyes of the IRS. As long as I'm putting in at least 750 hours maintaining these properties, and since tax preparation is a seasonal business, I can meet the third test that more than 50% of my time is put into real estate.
I just wanted to clarify on the last slide, that if your income is more than 150, you can't
Yeah, any losses from that rental property generates, you won't be able to take. It will just get carried forward with something that they call a suspended loss. And it keeps getting carried forward until that property generates income for you to apply those losses to, or you dispose of the property.
Oh, based on your income from that property, I'm thinking like if you have another job.
No, it's your income on your tax return. Yes.
Wait, say that again. So it is from just that property or
No,
from your personal income?
That 150, yeah, that's on your tax return. That's not from the rental property itself. Because I had
Per property, if you own like a pile of them, you take 25.
no, that's whether it's one property or 100 properties.
So the limit.
Yes.
25 total.
Total, yes. So we had a client that was a doctor who came in. We asked him, what's new with your tax information? He said, I brought a real estate rental property. Why did you buy it? Well, my neighbor said it's a good tax write-off. I get lots of tax write-offs from it. So he did it. Well, he was making $500,000 a year. He was well over the limit. He had losses, couldn't use them, but he didn't lose them. They got suspended and got carried forward until he eventually sold the property. This is just a tax court case of applying the real estate professional. This was a college professor who claimed he was a real estate professional. He did everything. He worked more than 750 hours, but the IRS audited them. He failed the third test, more than 50%. The IRS said, aren't you required to have open class time for your students, office hours? He said yes, didn't include that. When they added those hours back, he no longer qualified. So it's just a highlight of that you don't have to have a real estate license yourself to be entitled to this. This was another tax court case. They were denied the real estate losses because they failed the 750-hour test. This is a good example of keeping good records. The tax court judge said that she didn't include the hours of commuting from one rental property to the other. She didn't know she could do that, so she submitted those hours. The IRS said, no, you submitted it after the fact. We're not accepting it. The tax court judge ruled in her favor, said her records were so meticulous that this was just an oversight. It wasn't a disregard of IRS rules. So I put this tax court case in because it's a good reminder that if you keep good records, you will get the benefit of the doubt more times than not. Some tax saving strategies here. Employing children, hiring your children to work for you. You're shifting income from your higher tax bracket to their lower tax bracket. The work has to be appropriate for the age of the child that you have working in there. If they are under 18, they're not subject to the payroll taxes. So that could be an additional savings where you are subject to payroll taxes. And most of your tax credits out there are based on your taxable income, your AGI. By shifting income to your children, that could lower your AGI and maybe perhaps qualify you for more tax credits. Some people like to employ their spouse. They just love their spouse so much they want to work with them. Some of the thoughts is to maximize their Social Security benefits by shifting income from you to your spouse. You're increasing the amount of credits that they're entitled to when they go claim Social Security. By paying them, they have earned income through their wages. You can make a retirement contribution not only for yourself, but then for your spouse. And some people try to get a mini vacation out of it by taking your employee now on vacation with you to a convention or a trade show. You can deduct their expenses too.
What's the maximum Social Security income? hypothetically, my wife, let's say in this case, my wife doesn't work, I make $200,000 a year. How many credits am I getting in my Social Security at 200,000 as opposed to?
I don't know how they base the credits. I can tell you the income threshold is about 130,000. So once you make over 130,000, you don't get any more benefit towards your Social Security. So if you're making 200,000, if you shifted 70 to your spouse, then they're getting credits to their own Social Security. Got it? Any questions? That brings us to the end.
So I just had a thought, if you have an expense and then you have some lead source that takes a referral amount, is there any way to deduct that?
Yes. You just write it on the Schedule C as an expense.
The whole thing? Wow.
Yeah, the referral. So.
Like say they take,
So I refer a client to you?
No, I don't mean
like that?
I mean like some relocation companies, for example, will say, I'll give you this lead, but you got to give me 35% of your commission.
Well, if you are actually paying the commission for the income, then yes, you can deduct that on, your return. It's a valid.
If it goes directly to them, then you could. Like if you don't get the money, so you don't get the money. So it's true. So
yeah. I mean, you just got to be careful how you report it. If you got a $10,000 commission and you paid out $1,000 to them, then you want to make sure that you claim the full $10,000, take the $1,000 as the expense, and then you'll be taxed on the $9,000. That would be the proper way of doing it than just reporting the $9,000 as your gross income.
Gotcha. Yeah.
Just to clarify with the health insurance.
Yes.
My health insurance is paid by my husband.
Okay.
But we do have expenses that probably exceed that.
So if you have expenses that exceed the 10% threshold, you report them on Schedule A. You got to make sure you're still itemizing though. Since they've increased the standard deduction from 12 to 24, you might not even be itemizing anymore. Okay. So you probably want to look at your last year's tax return and see what that itemized deduction amount is. Okay. If it was like 15 or 18,000, well, you're not going to be itemizing. You're going to take the standard deduction.
Brian, I don't understand the whole benefit or all the benefits of being an LLC, being an independent contractor, being an LLC, doing an S corp. If you were to give advice to somebody that, let's say, they want a realtor,
okay,
how would you tell them to structure their business?
So, the first thing I would say is, I'm not an attorney. I can't give you legal advice. So, creating a legal entity has more to do with legal liability protection than say tax advice. Probably, I don't know what legal liability protection you're getting from just forming an LLC. I've heard lawyers say different things, that you're still ultimately responsible for your own acts, so they can still sue you and get to your personal assets. So that would be a discussion with an attorney to find out, does it even make sense forming the LLC? If you do form the LLC, an LLC is just a legal entity. It doesn't exist for tax purposes. There's certain default rules. If there's one owner, you're considered a disregarded entity, and you just report everything on your Schedule C. So to form a single member LLC, I would say there's no tax harm by doing so. You're still going to report everything on your Schedule C. If there's two or more members of that LLC, by default, you are a partnership, and you have to file a partnership tax return. You can elect out of that and become a corporation, both for the single member LLC and if you had a multi-member LLC, two or more members. That's a form you mail into the IRS that says, I want to be an S corp or a corporation, and you can do so.
But the S corp is more of a tax benefit.
Yes, that's the main advantage of an S corp over, I'll say, a partnership is the saving of those payroll taxes that we talked about.
But I can't file an S corp. I can't be an S corp unless I'm a LLC or an LP. Or
You got to file that qualified association first. Get your broker to sign off on it, and then you can form your LLC or you can form an S corp directly, and get your commissions paid there.
And what about the amount that you take as income versus, like, you can't, aren't there rules about that? Like,
There are rules about that. The IRS says you have to pay yourself a reasonable salary. Of course, the IRS doesn't define what that is. It's based on the facts of circumstances available. So I would just not pick a number out of the air. I would do maybe just a little research, go to one of those like pay scale websites or something like that. They'll give you a range, and you should document how you came up with your reasonable salary. Obviously, the lower reasonable salary, the more potential for savings. The IRS is aware of that. But I don't know, maybe I've seen people do anywhere from 40 to 60,000 in this area, and they'll pay themselves their W-2 and all the rest comes out not subject to the payroll taxes.
But don't imply that until your salary is about 250, probably not much benefit to go to an LLC. That's kind of general rule, or is that not?
Under the new Tax Law Act, I can't tell you whether it makes sense to be an S corp without looking at your tax return, because I can't make any blanket statements because it's going to depend on the individual return. Under the old tax law, I could, and I would say you want a $20,000 threshold between your reasonable salary and what you were earning, what you were netting on your Schedule C. So, for example, if you determine your reasonable salary is $60,000 a year, I would like to see at least $80,000 that you're netting on your Schedule C. And it's best that you're able to maintain that for several years. There's no point in making the S corp election because you have one good year and then your income drops down. Now you have the compliance costs of filing the S corp return and you're not getting those payroll savings. I would say once that delta difference is more than 20,000, it would be advantageous to, under the old law, to form an S corporation. Yes. Anything else?
Are you taking one more time?
Yes.
Thank you, Brian.
Yep.
Look for an evaluation.
I don't have my card, but you can email me there and reach out.
Thanks again, Brian.
Thank you. Yes, we do. Yes. Well, I do work year-round in taxes, but it is possible for someone that just does the preparation side of it. You know, you're only working maybe a quarter of the year, a third of the year doing they could qualify.
We want to set up LLCs.